I've gotten into this conference. To me, has been great. 78 panels, but I know that there's been a lot of interest, particularly in this panel on crypto. And we have amazing experts who are in the middle of the industry and the cases. And so I just want to hand it over to Stephanie Wickouski. Stephanie is a friend of mine, partners. She's one of the most accomplished, complex restructuring attorneys in the country. We both do indenture trustee work, but she's been more ambitious. She's actually written books on it. She's written a book on indenture trustee bankruptcy powers. She has a book on bankruptcy crime, which actually is relevant nowadays, I guess, and one on mentoring. So anyway, I'll turn it over to Stephanie for this great panel.
Thank you, Harold. As Harold said, I have the pleasure of moderating a panel on the hottest topic of the day. And it's one that has captivated the public's imagination and dominated social media. And that is the subject of cryptocurrency. Oh,
Thank you.
They're not on. Testing. Okay.
okay, can you hear me? Okay. Let me start again. First of all, thank you, Harold. I have the pleasure of moderating the panel on this room. I have the pleasure of moderating a panel on the hottest topic of today, especially today, which is a topic that has captured the public's imagination and dominated social media for some time. And that is the topic of cryptocurrency and what happened in 2022 that has changed the landscape forever. This is extremely timely, especially in light of the Locke filing earlier today. I want to introduce you to my fabulous panel. These are all the leading lights in the field. I almost can't believe that I have these 4 people with me on this panel. To my left is Patrick Doherty, who is a partner at Foley & Lardner. He specializes in securities and M&A. He's one of the top securities lawyers in the country. And he, in particular, is a noted blockchain expert. He also teaches the subject of cryptocurrency at Cornell Law School. To his left is Michael Wickouski, who is a portfolio manager at Mariner Investment Group. Michael is well known in the industry for in the investment community for his expertise and background in the field of cryptocurrency. To his left is Pat Nash, who is a bankruptcy partner at Kirkland & Ellis, and who's the lead counsel in the Celsius case. And to his left is Greg Pesh, who is a bankruptcy partner at White & Case, who's the lead counsel to the creditors committee in Celsius. So let me start this off by turning it to Pat. And we have 2 Patricks on the panel, so I'm tempted to say Chicago Pat, but they're both from Chicago, so I think I have to say Professor Pat. Professor Pat, could you set the table somewhat and tell us what is cryptocurrency and what do we need to know and why do we need to know it?
Thanks very much, and I'll try to be brief about an incredibly complex subject. A few risk factors, you can see them there as a securities lawyer. We write risk factors. I belong to a few organizations, but these are my views, and I guess I should add that I express views about bankruptcy, but I'm not a bankruptcy lawyer either. That's true. I'm going to talk to you about this is the Bitcoin white paper, which was published 14 years ago. I'm tempted to read the abstract to you. Jack Dorsey, a Twitter, calls this poetry. But instead, I'll just touch on the core concepts. Satoshi discovered and explained that cryptography, when combined with a peer-to-peer network, makes it possible for one person to transfer an asset what asset? Bitcoin. Transfer an asset to another person without using a bank, custodian, broker, to prevent double spending. You know what double spending is, right? It's the reason why the merchant calls your bank before she lets you leave the store with valuable merchandise, having paid for it with a personal check. Using the Bitcoin blockchain, notice Bitcoin blockchain, Bitcoin the asset, Bitcoin blockchain, there's no need to trust the financial institution to prevent double spending because the other participants on the public blockchain, the miners, verify the legitimacy of every transaction. Likewise, there's no central role for the government in these fund transfers. It's all private ordering. This is why libertarians in particular are enthusiastic about crypto assets. And it's what blockchain scientists mean when they say things like, code is law. So in the beginning of crypto assets, it was all about trust, or rather distrust. First, distrust of financial institutions, especially big banks, but also concurrently distrust of the government, especially big government, the state. Why? And why then? The landscape 14 years ago displayed big banks failing in the United States and Europe, Lehman Brothers, Bear Stearns, Merrill Lynch, many others. And the state was bailing them out. It was a hard time for everyone, but for libertarians in particular, it was the winter of discontent. As we move on, notice the elements of this new kind of asset, or aspiring currency, as I'll call it. They are, one, it is digital cash that is too widely accessible, and three, peer-to-peer, before, not issued by a bank. It's enabled by blockchain technology, by a distributed ledger. Notice also the distinction between Bitcoin, the asset, on the one hand, and the Bitcoin blockchain on the other. The blockchain is an open source software protocol. Again, Bitcoin is a crypto asset. Today there are many crypto assets. And Bitcoin is a public blockchain. Today there are many public blockchains. And notice this. The Bitcoin white paper did not call for crypto assets to be custodied with and traded by crypto exchanges. The original vision was peer-to-peer and self-custody. Crypto exchanges were created and flourished to solve what I'll call the last mile problem in crypto, which is this. Crypto has been mainly a retail business, and retail customers don't have enough computer literacy to self-custody their assets, and they can't be bothered to self-custody their assets. They also can't take the time to figure out where the other side of the trade is if they want to sell or buy crypto assets. I could tell you stories about the early days of Bitcoin, about how they were traded in public parks and in hotel lobbies by people standing next to one another and then hoping they didn't get shot when they left. I'll move on. I'll talk to you next about Ethereum blockchain and Ether, and I'll basically make 5 points to you. This is the second largest crypto asset. First, this is a public blockchain that was invented by Vitalik, I'll call him Vitalik, and a handful of others, Joe Lubin and others, backed by Peter Thiel, and it was launched in an ICO in 2014. Bitcoin, in contrast, was a fair launch, we call it in crypto, but there was no private equity in the deal early on. So this was a fair launch, but that was a fair launch. Ethereum was an ICO. It was an ICO that was not blocked by the SEC. I could write a book about that. Things to know about it, because these are highly relevant to the development of other crypto assets. Ethereum supports smart contracts. The term smart contract is a misnomer. It's an unfortunate one, especially when talking to lawyers, because you think of reps, warranties, covenants, closing conditions, miscellaneous provisions, etc. of a contract. It's not that kind of contract at all. These smart contracts are if-then statements. They're sort of like a Coke machine. If I go to a Coke machine and I put $1 in it, and it's $2 now, and I hit this button, out comes code. If I hit that button, out comes Diet Coke. That's the way smart contracts work. If this condition is fulfilled, then send the asset to A. If some other condition is fulfilled or neither one is fulfilled, send it to party B. That's a smart contract. That's code. So smart contracts can be created and run on the Ethereum blockchain. Decentralized apps, called dApps or dApps, are built, you can think of these as apps, they're built on the Ethereum blockchain, which is therefore the foundation for decentralized finance, DeFi. Ethereum was the very beginning of DeFi. Unlike Bitcoin, ETH is gas for powering transactions on Ethereum. The Bitcoin blockchain doesn't really do that. You pay transaction fees to move Bitcoin from one wallet to another. But things get built on Ethereum. Remember, there's the dApps are built on it. Layer 2, Layer 3, Layer 4 are built on top of Ethereum. You have to pay people to do stuff, and what you do is you pay them with ETH. That's the gas. And then the final point I'll make is, and this exemplifies staking. So Ethereum moved to a staking model. Bitcoin is famously proof of work, which consumes very large volumes of energy and is met with a lot of political resistance, including here in the Empire State, where just last week Governor Hochul signed a bill creating a 2-year moratorium on the enablement of additional Bitcoin mining using non-renewable resources. First state in the country to do that, and not good developing in my view. But I'll leave that aside. So proof of work uses a lot of energy. Proof of stake does not. When Ethereum switched to proof of stake, its energy consumption dropped by 99.5%, which is not trivial. Staking, important concept in all of crypto assets. Traditionally, stakers receive rewards for validating blocks, and the networks will select validators based on the size of their stakes and the duration that they've held them. What is staking? Well, if you stake a token, you basically lock it up for a period of time. You can't move it. Something like a CD issued by a TradFi bank, like any bank. To give you some idea of the economics, anyone willing to stake 32 ETH can become a validator. That'll cost you about $40,000 to buy the 32 ETH, give or take. And the yield on that is typically around 5%, but right now, because of everything going on, all the volatility in the market, you get paid 15 to 20% a year simply for staking your ETH. And by the way, if you don't want to bother with that, you can delegate the responsibility to stake to someone else who will do it for you and give you most of the return on it. That's what staking is. This is the universe of crypto assets as I perceive it. You won't read this in a book anywhere, but there are layer 1 crypto assets like Bitcoin, Ethereum, AVAX. We've got people here from Avalanche in the audience, which is AVAX. These are aspirational currencies, highly volatile. All these tokens are volatile. Then there are tokens that are designed to have specific uses. These are sometimes called utility tokens. Thousands of them exist. Only 3 have been okayed by the SEC. Then there are stable coins, which are called stable because they're pegged to fiat currency, typically the US dollar, it could be others. Tether, USD Coin, Binance, probably the 3 largest ones right now. Infamously, a stablecoin blew up early this year, and I'm sure that will get talked about on this panel. That was an endogenous stablecoin. What's an endogenous stablecoin? It is one where the other coin is issued by the same issuer or an affiliate by the issuer, which you can think of as trying to bootstrap your own credit. You know, my credit is backed by this sister company over here. Well, that works well as long as everything's going well. It doesn't work so well in a downturn. So endogenous stable coins are likely to be outlawed soon, and I think that's probably a good idea. Now, at this point, you're probably saying this is awfully complicated. This, it sounds kind of like religious to me. And my answer to that is, really, okay, how well do you understand US dollar flows? Because here's a chart of US dollar flows. We're not going to go through it, but my point is very few people actually understand US dollar flows. They don't understand that any more than they understand crypto. But they accept it as a matter of faith because they have been taught to accept USD and the US dollar system since childbirth. And because 2008 aside, very few banks have blown up. So that was Sam in better days, in happier days. And we're going to come then to the end of this brief talk, but I just want to point out the various disasters that we've been through, just in the last, we're not even through a year yet. And other people are going to have much more to say about this than I will. But I mean, the trigger for it, obviously, I believe, was the Fed tightening credit to ward off inflation. When they did that, risk assets sell off as they always do. Who knew? But now they do. The crypto assets also are risk assets. So they sold off even more than public equities did. Bitcoin immediately sold off 50%. It's now down 70, 80%. As an example. And various knock-on effects then occurred, various, when Warren Buffett says it's only when the tide goes up that we see who's been swimming naked. Well, the tide went out this year, and we saw, who's been swimming naked, beginning with Terra Luna, I mentioned. Three Arrows Capital was a hedge fund that owned a lot of Terra and Luna. When Terra Luna went to zero, that holding went to zero, and had other levered holdings of Bitcoin and other crypto assets. So, when they drew down very significantly, Three Arrows Capital was toast. Voyager, and I'm mindful that I've got debtors counsel from Voyager and Celsius here on the panel with me, but it's a public record that Voyager and Celsius had significant holdings in 3AC and in Terra Luna and in other elements of the ecosystem. And they were not just significant holdings, they were levered holdings. People have always asked me, God, crypto assets, that has a very high risk profile. Do you know anything that's riskier than holding crypto assets? My answer is yes, levered crypto assets. That's riskier. So that led to those insolvencies. FTX is just beginning, a story just beginning to be told. I thought, I want to introduce this panel, not dominate it, but that's really FTX and Alameda Research and all their affiliates, and we've all read about the transfer of customer cash from FTX to Alameda, which was, hedge fund, family office, prop trade, you decide. It was Sam's personal property, basically, and you're not supposed to use customer assets that way. So, major disaster there. Just this morning, you can tell I put this deck together this morning, because just this morning, BlockFi filed in bankruptcy in New Jersey. BlockFi, these are all, and I want to stop talking because I learn more when my lips are not moving, but these are, except for Terra and Luna, which were dominated by Do Kwon, and it was not decentralized because Do Kwon dominated it. With that one aside, none of these are decentralized crypto plays, not a single one. They are all what I will call unregulated banks, which are not registered as banks, unregulated finance companies that are not registered and regulated as finance companies, or brokerage firms or exchanges. In other words, they all have traditional finance managerial structure, operations, businesses. They made the mistake by and large of lending long in highly volatile assets on a leveraged basis, with short liabilities. That has never worked. That's what killed Lehman Brothers, and it has never worked. It's human beings that did this. It was not smart contracts that did this. Smart contracts have performed very well throughout this entire period, and in fact, they're doing better than ever right now. So, in a way, this is not a crypto story at all, but I will say that's my introduction about what crypto assets are and how we came to this contretemps.
Thank you.
And if you want these slides, just ask, I'll send it to you.
You know, we usually wait till the end for questions, but I feel that, Pat, you covered a lot of ground, and you've touched on some things that I know we're going to talk about more while we're here. But does anybody have any questions before I, yes?
What's to stop another engineer from just creating another, set of bitcoins?
Well, you can do that, but you're going to have to get miners around the world to agree to mine it, and it's very expensive to do that. We have sitting in the front row the gentleman Phil Liu, who was the #2 man in Bitmain, which was the biggest Bitcoin manufacturer in the world, based in Beijing. They had hundreds of millions of dollars invested in the ASICs that were used to mine Bitcoin. Bitcoin is very expensive to mine. It's a huge capital expense. And so, yes, you can do that if you have an awful lot of money, but you're going to have to convince many other people to mine it and to incur the expense, and they would rather just be Bitcoin miners than incur that expense and that risk.
And this might be a segue to what
Yes.
Mike's going to talk about. But in light of all those expenses,
Yes.
this isn't a perfect analogy, but Celsius with their Cell token, Voyager with the VGX token, FTX with the FTT token, they're not perfect analogs, but in an effort to sort of cut out the cost but still have like another form of crypto asset that could be traded, all these exchanges came out with their own sort of proprietary token that they would use as sort of like a frequent flyer program for you if you use their program. So FTX, instead of giving you cash for using the program, they give you these FTT tokens, and then those would start to migrate among all of these different exchanges. And it's not a perfect analogy, but it was a reflection of a desire, one, to sort of make something out of nothing, but two, to create other crypto tokens without having some of the massive setup and startup costs that ETH and Bitcoin, which are the two primary cryptocurrencies, have. So, but that's also what kind of led to a lot of these problems, is they were effectively printing their own money, valuing it themselves, and then lending based on those valuations, which is a big reason we got into the problem we have today, right, Mike?
Thank you for that. That is a great segue in terms of teeing up about 2022. And I just want to check, is this on? You can hear me?
No.
Table it. Stephanie, can I steal yours?
You can buy it.
I'll take yours. Take any one that works. How about that? Here we go. I'm going to start with the conclusion, and by the way, it actually answers the question from the gentleman in the back, which is that my personal opinion, I think Bitcoin is tantamount to digital gold. I think it's immutable. I think it's irreversible, and like all frontier markets, there are going to be growing pains. And 2022 is going to leave an indelible mark on the transformation of this industry. With respect to the question in the back, I think when you read through the white paper that Pat put up on his first slide, it'll become abundantly clear that the amount of catch-up, the amount of megawatts that would need to be expended for someone to replicate the Bitcoin blockchain at this point would be prohibitively expensive. So I do think that they've created digital gold. But under the heading of starting with the conclusion about what I think happened in 2022 and where we go from here, I see a lot of investors in the room, a lot of lawyers in the room. Who knows what stock parking is? Who knows stock parking? So anyway, what is stock parking, if you know what it is? All right, well, okay, so it's basically, so what, we have an answer? Okay, never mind. I'll tell you what it is. Basically, it's when you move stock off your balance sheet over year end for the purposes of window dressing your books or avoiding taxes. And in 1989, Paul Bazarian was famously convicted and sent to prison for stock parking. The reason we all know about it, and certainly I know about it, is through taking the Series 63 exams to be able to invest and talk to customers in a regulated securities industry. I had to learn about all of the previous frauds and workarounds that led to ill-gotten profits. They were part of the mess, and frankly, that's where I think this industry is going. I think when you take your Bitcoin or crypto regulatory exam, you will learn all about the non-segregation of assets, the lack of collateral. I think it is something that is irreversible, so I see this as just part of the evolution of a frontier market. There's a great book by John Kenneth Galbraith called A Short History of Financial Euphoria, and it's a very quick read, and when you read it, you will smile. I think living through this episode in 2022, you have to read it, because history doesn't repeat itself, but boy does it rhyme. Back to the tulip mania in 1636, did you know that tulip bulbs in the 1600s were selling for $25,000 to $50,000 a bulb? And that's in 1600s dollars. That is a tremendous amount of money, and not shockingly, people took out loans to buy tulip bulbs. And they did collateralized loans that were backed by tulip bulbs. And in the aftermath of that, they ran to the courts to try to fix it when they all got bankrupted. And the courts were no help because they deemed it to be a gambling operation, so they wouldn't hear the cases. Fast forward to today, I think this industry was on a trajectory to become a fully embraced system for storage of wealth, right up until the point where people started lending coins and started providing yield on lending coins. And when you read Galbraith, the last sign of every bubble is lending and leverage that far outstrips the system's ability to pay. So I think lending is fairly new. Celsius was set up in February of 2018. The founder of Celsius famously said, quote, "There are no rules in this business." Well, there will be. And I do think that the price action on Bitcoin from 40,000 to 60,000, a lot of that had to do with the advent of leverage. And so you're seeing that leverage come out of the system, and markets always overshoot. But there's nothing about any one of the cast of characters who have done inappropriate things with customer money that makes the actual blockchain technology any less viable, and Bitcoin as a store of value any less valuable. You know, people talk about crypto chapter 11s as a very broad topic. The topic of the panel is crypto chapter 11s, but I think if you dig another levels down, given the number of members of our bankruptcy bar in the room, you will recognize the patterns. But Voyager is akin to Refco in that, you know, ostensibly you had segregated customer funds that were used to pay off bad loans or to make bad loans. There's a Lehman element to that, in that it's a classic run on the bank. Celsius also has a Lehman element in that there was an asset liability mismatch, and subsequently a run on the bank caused the company to have a massive liquidity crisis. I think it's must-read reading. There is a New Jersey complaint that was filed by the U.S. trustee as part of their motion for an examiner. It's docket 546, filed on August 18, 2022. And it's required reading because I think while the underlying Bitcoin token may not in itself be a security, I think where you lend it, you make it a security under the Revit's test or the Howey test, and there's plenty of securities lawyers in the room who probably know this a lot better than me. But if you're a student of this industry, if you actually think there's a future in it, it's probably required reading to understand some of the things that can go wrong.
Block, if I could interrupt, Jeff?
Sure.
You know, in February, BlockFi paid $100 million in fines to the SEC in the States to settle claims exactly like what you just described. And I thought BlockFi's business model was very like the Celsius business model, very like the Voyager digital business model, but there was, and I'm not involved in those cases, there are people here who are, but nothing of the sort happened to Celsius or Voyager. And so the SEC has come after this industry, certainly a little bit, but they a little late, perhaps, in a couple of cases here.
So the other two that I would just mention, then I'm done. But the FTX is MF Global, where, you know, I'm sure SBF didn't set out to misappropriate customer funds, but they got in a pinch. And I'm sure John Corzine intended to put all of the money back into customer accounts if he was using the post collateral against his Italian bonds. But they're slippery slopes. And the last one that I would mention is Compute North. Under the heading of not all crypto bankruptcies are the same, I saw something on the docket today that apparently it's liquidating, but the Bitcoin miners are a totally different kettle of fish than some of the more recent frauds. And I think it's what gives Bitcoin its inherent value, is that it takes a lot of megawatts now, given how long the blockchain is. It takes a lot of time and energy to find a coin.
Michael, explain to the audience what the economics of Bitcoin mining are. So why is Compute North in trouble? Why are other Bitcoin miners in peril now?
Yeah.
Explain that, if you would.
Yeah, so the original Satoshi white paper sets up the allocation of coins by solving this puzzle. It's like a Nautilus shell where it winds in. So every 10 minutes, someone finds a coin, and you're awarded 6 1/4 coins for solving the puzzle and verifying the blockchain. In 2024, that number will go to 3 1/8, and then it will get cut in half again every 4 years, and cut in half again, and it kind of winds in until the last coin is found in 2040, and there will be 21 million coins outstanding. That's it. Now, the reason people are spending billions of dollars to buy these ASICs, which are application-specific computers, basically designed to do one thing and one thing only, and that is take a million guesses a second at the puzzle answer to try to verify the blockchain to find a coin. The reason people are spending that money is because these coins have value. But the issue now is power prices have gone up and coin prices have come down. And in an industry that's fairly simple, it's megawatt hours in and it's coins out, where your cost of goods sold has tripled because gas prices are higher in the US and around the world. And the thing that you're producing, your end product, has come down in price by 65%. Boy, that's a recipe for disaster. And when I put it in that parlance with cost of goods sold and revenues and products that are produced, it starts to kind of look like a regular old company. And just to put it in context, you can go to a website called bitcoinmarketcap.com, and Bitcoin market cap from November 21, 2021 to November 21, 2022, so just 1 year, very recently, Bitcoin market cap went from 2.6 trillion to 900 billion. And people say, wow, that's a huge drop, that's a huge wealth wipeout. Ironically, I went back, because I heard someone throw this stat out and I wanted to verify it myself. During that same window, November 21, 2021 to 22, Microsoft and Amazon in total wiped out 1.7 trillion of value. So we look at this like it's a big business because it's page 1 of the journal. It's in its infancy. That's just 2 stocks that wiped out 1.7 trillion of value, which is all the market cap of Bitcoin and crypto that's been wiped out as a result of these various business failings.
You know, Mike, on some level, you know, I think that the mining piece of this is interesting because you mentioned Compute North. That's the one hosting company that's gone in so far. Celsius is the only exchange, though, that also had stapled onto a mining business. So you have sort of like both of those issues there. But, you know, at some level, it's almost like the shale oil company bankruptcies from a couple of years ago. You know, they're trying to get oil. Everyone wants oil. It just the cost to get, that the oil is just so expensive, they had to, cut the debt to get there.
So that analogy holds even more than you may, or others may be aware, in that, when everyone spent money on rigs to drill and drill horizontal wells, they were drilling where their marginal cost was, their marginal cost was negative because of where oil went to, but no one wanted to be the first driller to shut their rig down. And we're in the same situation today. Given the pricing in power and the move in coin prices, unless you have a very, very efficient miner, you probably should shut down. Your marginal cost of production of a coin is about $15,000, and the coin itself for $15,000. So a rational economic animal would shut down, but much like the oil and gas crisis where people overbuilt, no one wants to be the first one to shut down.
I would, Pat and Greg, like to draw you into, discuss a couple of the issues that arise in these cases. Let's talk, if you don't mind, about customer accounts. And I'll set the stage for that just a little bit. These entities, by and large, don't have big secured claims. The big banks didn't lend to them for the most part. And they're largely unsecured claims, overwhelmingly unsecured claims. And the unsecured claims very largely are customer accounts, customer account claims. And a lot of that's retail money. Now, not so in the case of FTX. I think the top 50 claims in FTX aggregate more than $3 billion, so that's $60 million per claim. Those are institutional accounts, but Celsius, Voyager, not so much. So you've got all of this customer money in these bankruptcies. What is the correct way to classify those claims? And do customers deserve any kind of priority versus other creditors? And by the way, I know this has been briefed and there's decisions coming, so I'm not asking you to predict, how judges are going to rule, but you can, at least speak to your own positions on the matter, and, what you think the right answer should be, and how you get there, and your reasoning, if you don't mind.
No, I don't mind. Look, I think it depends on the company, it depends on the case, it depends on, that company's terms of use. I mean, our view in Celsius is that from the debtor's perspective, it's pretty clear that when the customers deposited their coins on the platform, they transferred title to their coins to Celsius. They did that, and the one thing that, Mashinsky did, he was very clear. You put your coins on the platform, I'm going to rehypothecate them, and in return for you allowing me to rehypothecate what had been your coin is now going to be our coin, I'm going to pay you a yield. And we don't have any funded debt in Celsius. The entirety of our, claims base is, we have customer claims. Our creditors committee is, really a customer committee. We have some other stakeholders. We've got some preferred equity investors who invested a heck of a lot of money into the company as recently as January of 2022. But, the reorganization effort, the focus of the bankruptcy case at Celsius is very much customer-centric, customer-focused, designed to maximize the recovery for the customers. And, as a debtor's lawyer, what I find most challenging about Celsius is, you can't minimize. These are retail customers, almost not exclusively, but the vast majority of them. And many of these folks deposited their life savings onto the Celsius platform. And, to say that this is a life-altering event for them is an understatement. And so there's a ton of emotion and a ton of big-time pro se customer activity in the case. And there's just been no way to break through. Like, for example, Kirkland & Ellis came on the scene on June 30th, June 29th or June 30th. We filed Celsius for Chapter 11 on July 13th. in between June 30th and July 13th, there was that, it's basically like a 5-day 4th of July holiday. I mean, we were brand new to the situation. And we were answering to, and we continue to answer to, 2 independent directors who had been introduced into the situation on or about, June 17th or 18th, about 2 weeks before we were introduced into the situation. And there's just been no way to, in my view, or, look, the other thing is we've got about 600,000 customers, creditors. And we hear from a very, very, very vocal minority of pro se customers who have, valid complaints, concerns. The emotions run very high. The reality is we are 100, when I say we, the debtors advisors, the 2 independent directors who had nothing to do with anything in the past. Nothing to do with how Celsius finds itself, where Celsius finds itself today. We really are trying to maximize the value of the platform, for the benefit of the customers. You effectively, it feels almost like you have, 600,000 individual customers who, okay, if the terms of use says that I transfer title to my coin, okay, maybe it did, maybe it didn't. They're not going to concede that it did. But even if it did, and a lot of the pro se folks, they don't know how to exactly articulate it, but what they effectively are saying is even if that's what the terms of use says, there's a constructive trust around the coins that I put on the platform. I was misled, I didn't know what I didn't understand what I was signing. I was misled by public statements and YouTube videos and whatnot. And so again, it's not always articulated this way, but effectively, notwithstanding what the terms of use says, there should be a constructive trust around the coins that I put onto the platform. The problem is we can't try 600,000 constructive trust cases, which is very fact specific, right? And we'd be putting 600,000 constructive trusts around property that we don't have. So you get this sense that what folks are articulating and what they're advocating for doesn't even help them. Because, okay, there's a constructive trust, but we don't have your coins. So what are we going to do about it collectively?
Yeah, I think just to emphasize the last thing Pat said, in Celsius and Voyager, probably I'm guessing these other ones, definitely FTX. That's the fundamental problem. Is I keep telling people there's a math problem. Is that even if you did hypothetically owned the coins, they're not there anymore. They're gone. And even though there's blockchain, we often don't know where the coins went. So customers of Celsius deposit's the wrong word, but transferred about $6.5 billion of coins to the platform, and depending on the value today, Celsius has around $2.5 billion of coins. So they're missing effectively missing kind of is a pejorative word, but over half the coins are not on the platform, and even if you own them on the platform, are not there. So it's a fundamental math problem. I think one other kind of piece of context, though, and I think the way Professor Pat laid this out on the screen sort of helps, even though it's sort of sequential, it kind of helps think about these issues in the property issue that comes up in these cases, because on one end of the spectrum, you have Voyager, which is kind of like the Model T type case. They had, I don't know if they had any kind of what's called custody function, so a function where they held coins, but basically on behalf of the account holder, and it remained the account holder's property. Voyager had very little, if any, custody arrangements. So to Pat's point, the expectation in that case is the company, the debtor, owns the coins. People have a claim against them. The other end of the spectrum is BlockFi, which, as Mike mentioned, started to settle this with the SEC and the states, and had a framework where basically they were creating a security compliant custody function. So they put the coins in custody accounts, or they were supposed to, and that was signed off by the SEC. Celsius sort of falls in the middle because it didn't have a deal with the SEC, but it tried to mimic what BlockFi did, which causes a lot of the problems, because what BlockFi did itself might not even have really entirely worked, but Celsius couldn't quite pull it off. So Celsius has some sort of like execution issues getting to the BlockFi type of the world, side of the world. And then the other kind of variant on it is FTX, which, you know, seems, whether it had custody or not, just sort of freely ignored any kind of separation between the coins and the accounts. Whereas there was some, you know, effort in BlockFi and Celsius to have some kind of semblance, although there was a lot of questions about how effective that was. So in this next wave of bankruptcies, you know, I think what you're going to see a lot of is the question of custody. What coins are in custody, what weren't in custody, and the coins that weren't supposedly in custody, how, you know, sturdy was that? Were they actually treating them separately? Did they trace them? Or was it just sort of, you know, a big mishmash?
Yeah, and you know, fascinating issues. When Celsius created their custody program in April of 2022, there were certain customers who, first transacting with Celsius, deposited coins into the custody program directly. I think more common, though, was folks who transferred coins. In Celsius, we have what we call the Earn program. This is where you deposited your coins onto the platform, transferred your coins to Celsius for the express purpose of Celsius rehypothecating those and paying you a yield. And we had then this custody program that was developed in April of 2022, and tens of thousands of customers migrated from the, you know, the coins were taken from the Earn program into the custody program. And that happened to the extent that happened within 90 days of the filing of the Chapter 11. You know, you get into preference issues, lots of fascinating issues. But, you know, interestingly though, the vast majority, I think, from a dollar amount, you know, most of Celsius's customers have very small dollars on the platform: $1,000, $2,000, $400, $700, $11,000. But it is really very retail, and you know, there's that preference. Any transfer within 90 days that's below what, $7,750, I think, is the. You know, if it's a small enough dollar amount, it's per se not a preference. And I believe, I think I'm in the right zip code, it's $7,750 for the cutoff. And so folks who transferred coins from the Earn account to the custody account, but under that preference limit, you know, should we be treating them differently as compared to folks who transferred coins in an amount over the preference limit? You know, one other thing about Celsius, just which is making it, you know, an interesting Chapter 11 and an interesting, you know, reorganization possibility is for all of the things that Celsius got wrong, and they got caught sideways. There was contrary to what some of the folks have said, you know, they're not in Chapter 11 because of Three Arrow. Their exposure to Three Arrow was very small. They're not in Chapter 11 because of exposure to any other, you know, single or couple troubled platforms. They, you know, made some bad investments, loaned out, you know, engaged in rehypothecation, you know, strategies that didn't work out. And then when Three Arrow collapsed, this is probably an oversimplification, but it's for horseshoes and hand grenade purposes. It's not that far off.
Yep.
When Three Arrow collapsed in May, right around that time, Coinbase had the now infamous, you know, footnote in their 10Q where they warned all their customers that in Chapter 11, you're probably an unsecured creditor. And you had some of the other collateral consequence of the Terra Luna collapse, and then Three Arrow, and then Voyager, and there was a pretty classic run on the bank. And Celsius, you know, there were withdrawal requests that Celsius, you know, foreshadowed their inability to ultimately comply with, and hence they instituted the pause. But, you know, unlike what we're all reading about, I don't have any inside information on FTX. What I know about FTX is from what I read in the trade rags and the popular press like the rest of you. But, you know, at the Celsius first day hearing, you know, it's going to sound like I'm straining my elbow and pat myself on the back, but we were able to, you know, I was up there doing the presentation, and I was able to show the judge, okay, you know, on January blank date in 2022, we had 6 billion coins, or whatever we had. And, you know, on this date, we had these many coins. And on the petition date, we had these many coins. And I actually walked through the judge. Again, it was probably horseshoes and hand grenades, but could actually articulate for the judge, you know, and this is why we went from here to here. Here's where we lost money, here's where we lost money, here's where we made a bad investment. And so on the petition date, we were able to, you know, do that walk for the court, for the stakeholders. And, you know, we knew how many coins we had. We knew specifically by coin how many we had. We had them safely stored. We knew where they all were. We then worked out a protocol with the UCC to make sure that they were even more safely stored. But I, you know, tend to think we look pretty good compared to what you're reading about, you know, in the market today.
You could account for your assets. I bet you knew how many employees you had.
We did. We knew how many employees we had. We had a wage motion. We knew how much we had paid them.
And I think it's interesting. You know, my firm is involved with FTX, so I'll be a little circumspect in what I say here. But you know, there's a lot of focus in the FTX bankruptcy over all of the. I mean, they have a picture that's in, you know, the Financial Times of like the flow chart of the 200 different investments that FTX you know, had minority equity investments in. I think it's really informative for thinking about a bigger issue with crypto, which is people were very fine to put crypto on these platforms and not really question why Citibank gives them like 0.25% and these platforms are giving them 15 or 25%. And the fact of the matter was that they were basically making insane investments, largely in a very incestuous VC community. So like, you know, they're giving you 15 to 25% because they're investing in, you know, SBF or Alex Mashinsky or whoever, you know, founders of Voyager. You know, their friends and families own highly speculative crypto blockchain investments. And, you know, that's really been kind of thrown open in the FTX bankruptcy, but that's really like a core issue that's in Voyager, Celsius, and I'm sure it's going to be in, you know, BlockFi and these other ones, is they were just making very risky investments in very risky companies. So, you know, that's just what happens with a bank that doesn't have, like, you know, the FDIC or the, you know, FDIC looking over your shoulder or true risk management. So, but that's a big piece that's sort of been obscured in these other cases, all these crazy investments they were making. I suspect that's going to come more to the fore, just given the quantum of what FTX seems to have been investing in to generate its own efforts at yield.
I have a couple comments. Notice it was live human beings who were making those investments. It was not decentralized protocols that were doing it. Smart contracts were not making those investments. The Bitcoin blockchain did not make those investments. The Bitcoin blockchain doesn't even know that any of this has happened. It doesn't especially care what any of us think about it. It's not live human beings. It's protocol. But so these are the failures of live human beings in centralized financial institutions. Notice the way Pat Nash described the customer contract and customer expectations, notice how very different that is from a brokerage firm or a bank, for example. If a customer puts $700 in, I'll choose a brokerage firm, into a brokerage firm, the brokerage firm is required to segregate customer assets from its own assets. It's required to keep a sufficient reserve to cover customer claims. If the brokerage fails, which occasionally happens, it's insured. The customer accounts are insured on top of it. So none of that is at present here. These are not insured assets. There will be no taxpayer bailout of any of these institutions. And it appears that there were not segregated accounts in very many cases, because the terms of services, they don't have to be segregated. You can but it's yours. These are your assets now, Mashinsky, that I've given them to you. Just a very different environment from the regulated world, and different from regulated bankruptcies. We have got just about 5 minutes left, I think. We've talked about customer assets. The global digital asset and crypto Currency Association is an aspiring SRO, of which I'm on the board. By the way, my chairwoman's here, Renata Scott. Well, thank you very much. Renata's also with INX, which has a security token solution that you ought to consider in your bankruptcy cases. There is something you can give claimants who otherwise would not get cash. Maybe they should get some kind of token that they can trade. Anyway, just a thought. Talk to Renata about that, not me. But so here are some things that we've been thinking about, should happen on a go-forward basis. These are, core principles that maybe these centralized digital asset businesses should adopt. I just throw them up there and ask you, do any of you have any thoughts about it, even on the panel? Capital adequacy, to me, it seems like an obvious one. I don't know. Celsius was levered almost 20 to 1. Voyager was levered, I think, 23 to 1. When banks were levered 30 to 1 in 2008, they went down, and they were not investing in long-tail crypto assets. That seems like something that should happen on a go-forward basis. Stress testing. These are recommendations that we're presenting to the industry, and I'm sure this will get talked about in Congress in the lame duck and then next year. Just some ideas I throw out there. Pat, Greg, you're in the middle of these wars. What else do you think is worth noting in the time we have remaining?
I think the regulatory piece here is really interesting. There's obviously a very interesting public policy aspect that's going to come out of all these crypto bankruptcies. But I think an interesting issue that Pat and I are dealing with on a real-time basis is dealing with these regulators on how to clean up what happened in the Voyagers or Celsiuses of the world. Because on one hand they have a mandate to ensure consumer protection, but a very large number of the people in Celsius, at least, they at least want to get some money back, or they want to get some crypto back. The regulators have to make a fundamental choice about how they're going to approach these cases that are already there. And I think it's an open question whether they kind of have the financial or political or statutory sort of gambit to kind of do what's needed in these big bankruptcies, given how complex they are, and if they're not, unless they're just going to be sort of a straight liquidation, which is not the goal of Celsius right now. It's going to be an interesting question to see if they can do that, dealing with the regime that we have, and not one that might come out in a year or 5 years or something like that.
I was chilled when you mentioned the next wave of bankruptcies. I got to tell you that a few minutes ago, but apparently there's more coming, folks.
There's always a next wave. I think we're at the end of our time, but I would be remiss if I didn't at least ask if anybody had any questions. I have a lot of questions, but I won't ask them.
There's a cocktail hour, so you can ask questions. Sir.
So we're not talking about traditional capital structures with these firms. Where do you all see the investment opportunities, if any, in these bankruptcies? I've heard that there's some active claim trading going on for some of the client claims, but are there any other investment opportunities that you all see in these bankruptcies?
Yeah, I think there are. There are corporations, and some of them have debt. Some of them have, as you mentioned, there are customer claims that trade. So there are some actionable investments. It's not a lot of debt, and obviously, as bankruptcy and financial restructuring professionals, the debt that can be paid is typically the dinner bell. You don't have that here, but there are definitely good old capital structures like you normally see them with debt, preferred, and equity issuances.
FTX is a very complex capital structure, hundreds of subsidiaries.
But I think if I understand your question correctly, I think there's a couple different ways to look at it. Some people are talking about taking these businesses and turning them into new platforms. That's a very capital-intensive issue. So there's a good chance that if busted exchange if a busted exchange wants to turn into a new regulatorily compliant one, they'll need capital to do that. These mining businesses, as here, are extremely capital intensive, and if you were to separate them from the customer assets that historically funded them, there'll be a need for capital there. And then, on a different level, you look at these businesses like Celsius is a pool of $2.5 billion of capital that's held captive right now by the bankruptcy process. Voyager is $1.7 billion of capital. FTX is going to be tens of billions of dollars of capital that's held hostage. There's different, it'd be interesting to see if people somehow try to find a way to, use that capital to kind of generate a further return if they could get control of it. But, those are, and then on the mining thing, like I said, those are kind of like conventional industrial businesses that are going to need a lot of cash. I think the final thing, maybe just to throw it out there, is it's not a surprise. There's a lot of litigation claims against the insiders and all these bankruptcies. I think it'll be pretty interesting to see how the litigation funding community, if they step up to try to provide some liquidity there, because otherwise, as you see from Card and MF Global and Matt and Madoff and all that stuff, people wait 10, 12 years to get the distribution. Those cases sort of preceded the current litigation funding environment, but if you could find a fund or an investor that was willing to somehow underwrite that to give some type of interim distribution to people while those cases play out, that might be an interesting thing too for certain investors.
A lot of the funds that are invested in FTX, I think, are under pressure right now from their own LPs who are saying, what were you thinking? So there may be those sorts of claims too.
I want to thank my wonderful panel.